The Federal Reserve was stepping on the neck of the bond market and things got out of whack. And that's when you get these inversions that ultimately make it hard for banks and financial institutions. And they're supposed to be making a positive spread. When you're lending long, you're getting a higher interest rate than when you're borrowing short. So this makes it very hard for the economy to keep chugging along. Hello, DR. How you doing?
Hey, Richard, I'm doing great. Greetings from the eastern shore of Maryland. Glad to be able to spend some more weekly time with you talking about the ever-changing, ever-interesting market landscape we're in.
Seems like the July seasonal bullishness that we talked about last week so far, at least, is playing out.
Yeah, it's a weird anomaly, I think, in the middle of the summer, in the middle of all these other weak months, 2 weak months before it seasonally, 2 weak months after July seasonally. But this one, traditionally strong. I guess people just want to get everything done so they can take the rest of the summer off. But yes, strong start.
And helped by the CPI number this week, which everybody seems to be breathing a big sigh of relief.
I think so. And when you look at it, I think it was a bigger help, a bigger slowdown in inflation than many people were expecting. And then, of course, on Thursday morning before the market opened, we got the PPI, the producer price index, and that too came in a little bit better, a little bit slower than expected. And the markets tended to like that as well.
There's been a narrative going on for a long time that the last mile of inflation is going to be the toughest to conquer. You think we're there? You think we're at the last mile?
I believe if we get another tick, Richard, that's this low, that if we stay in that 3% or less range going through the rest of the summer, I think that will be very telling in the consumer price index if we stay in that line. In my analysis and the things I'm looking at, what a big part of what we've seen have been some pandemic upsets, all the things that we talked about with supply chain, which were very real. And if those continue to not rear their heads again in the nearer term, I think we might be okay for a while.
So you think the Fed has done it? They've threaded the needle. They've landed the plane of the economy on the runway without the airbags popping out?
Wow. I would love for you to give us 7 more analogies and metaphors for a soft landing. But in the interest of time, I'll say no, I don't think the Fed did it at all. I think that the global upset that we had due to pandemic restrictions reared its ugly head really much faster than people thought it would, or some people thought it would. And now it's calming down faster than people gave it credit to be able to do. And I think that's basically what we're seeing. What's your take on that, Richard? Why do you think that we have had CPI slow down in the United States to something that's not at the target yet, but 3% is a lot more reasonable than 8%?
I'm still stuck back in the 1970s when there was an initial, war against inflation, got back down to even, below 3%, 2%, and then had 2 more dramatic upcycles before finally settling into the deflation of the last 40 years. And so I'm not convinced that this is more than just a anomaly. I think that some of the things we'll get into as we look at the data a little more today might raise some questions. So I think we should take a look.
I found a chart from Visual Capitalist that just came out since, it's a great site, been doing great work for decades. And this chart came out since we had our market moves discussion last week, and it shows the military spending for all the biggest countries in the world. And I think it's quite interesting that we get number one with the bullet is the United States out here at almost $900 billion. And number two won't surprise anyone that it's China, but that it's almost a third of what we're seeing being spent in the U.S. on military outlays every year. And I think that's really the main reason that the U.S. will continue to have risk-free rate of returns. They can generate revenue, tax their citizens, and they can maintain the walls around the country without having to think about, oh, we're going to get taken over by something in the near term. And that is a very simple reason why.
Let's hope that's efficient spending of $900 billion by the United States. I worry a little bit that some of that might be bloat and might not be a dollar for dollar comparison here between, say, a startup and a established, comfortable behemoth.
I think that that word bloat is probably all too on the nose for this particular example, Richard. We'll just leave it there.
But in the meantime, the point, well taken that, look, the United States has the biggest military, the most expensive weapons, and they're the least threatened by unrest or war, certainly within the United States. So point well taken, and that definitely contributes to the idea of why the U.S. is where people put their money when things get a little dicey. And why treasuries are considered, the risk-free rate of return. So let's talk about yield curves. This is USTreasuryYieldCurve.com. And, I think somebody just puts this site up for free. Thank you. And this is the current yield curve for U.S. Treasuries. And it might not be a familiar chart to most people, but what's showing along the bottom here are the durations, right? 1 month Treasuries are earning 5.36%. 2 month Treasuries are earning 5.5%. 6 months are earning 5.53%. And then making our way out, 10 years right now are earning 3.86%. So this is what is called an inverted yield curve, right? We're not supposed to be getting, if you're going to lock your money up for 10 years, you expect a higher rate of return than if you're going to lock your money up for 1 year, right? If you go to the bank and say, hey, I want a 5-year CD or I want a 3-month CD, the natural expectation is that if you're going to lock your money up for 5 years, if that entity, the bank, is going to have use of your money for 5 years, right, then you expect to earn a higher rate of return. But that's not the case in the economy today, right? You're getting high rates on short term, and you're not, and much lower rates on longer term. So the spread between the 6 month, at 5.53 and the 10 year, if we take the 10s minus the 6 months, that's, almost negative 2%, right? So that's not the way it's supposed to be. This is an inverted yield curve, but these numbers are up. Okay. Like we can compare this now against even 2 years ago, DR. So I'm just going to actually, the site is a little quirky, but we'll work with it. So now here's 2023 that we were just looking at here, right? Here's our 3.58 on 3.86 on 10 years. Down here is 2021. So this was just 2 years ago. We were earning 0% from treasuries all the way out to, 1 year was earning 0.08%. And today, just 2 years later, 1 year earns you 5.35%. That
Yeah, well,
is,
there are two
that's,
things that people look at, Richard, I think, in terms of why that curve gets turned upside down and why you get such big rates for short-term loans to the government. And the two theories, I'd love to hear you weigh in on them. The two theories are there is a flight to quality. And maybe the previous chart where we looked at military spending and what was happening there, that during times of uncertainty, when investors don't know what's going on in the near future, they go to the safest place. That would be the flight to quality argument. The other argument would be that this is showing that coming ahead, there's some economic upset that people are worried about, and that they might be concerned in putting their money in some place safe. So you've got a couple of different arguments: a flight to quality argument or a recession forebearer that people look at for an inverted yield curve. What's your take on where we are there?
the inverted yield curve, I think the inverted yield curve is not as big a deal as the fact that for the last 20 years, we've had these periods where interest rates have been held artificially low. So this, getting paid 0.1% on 1-year treasuries in, 2 years ago in 2021 was artificial. That should not have been held low. And I think that the inversion in the yield curve today is actually coming from the fact that, the Federal Reserve was stepping on the neck of the bond market and things got out of whack. And that's when you get these inversions that ultimately make it hard for banks and financial institutions who borrow short, right? This is what they got to pay over here to borrow money short term and lend long. And they're supposed to be making a positive spread. When you're lending long, you're getting a higher interest rate than when you're borrowing short. So this makes it very hard for the economy to keep chugging along. And I continue to be skeptical that it's not going to ultimately have more unexpected consequences for the economy. And I think it's very interesting to look at the yield curve through history. And I think this site really lets us do some interesting things. So right here, this is just a chart of the S&P 500 DR going back to 1997 to today. Okay.
Right.
So let's take a little financial tour through history and look at what was going on in the yield curve back here in in 2000. Okay. So we'll start over again. We've got our 23 yield curve. We're going to pin that there. And let's go back and look at what the yield curve was doing in 2000. So here's the yield curve in 2000. Interest rates were a lot higher, right? They were higher even than they are today across the curve. And we had a little bit of an inverted yield curve. So the 2 years were higher than the 10 years and the 30 years, but nothing like today. But still, interest rates were higher and kind of corresponded with the top of the market. Now let's go look at what was happening with curves, with yields in 2002, 2003. Whoa, 2002.
Wow.
Post 9/11, yields, again, stepping on the neck of the bond market. And short-term rates held artificially low, right? The Greenspan era. 2003, still rates artificially low. And if we go back and look, all through this time, 3, 4, 5, 6, 7, rallying, right?
Market rallying hard, yes.
Rates are still low. Still pretty low. Starting to go up. 2007, going up. Right now we're getting comparable back to the 5%. even, plus 5% on longer term, not inverted. And what does the market look like in 2007? Right around here.
Kind of,
And then boom.
kind of
So,
toppy.
2008, oops, rates coming back down. Let's inflate the market again. 9, 10. Okay, long-term rates are up, but short-term rates are still down.
Still down.
11, oops, way down, right? So where's
Now,
11? Somewhere around here. All this time through here, we're going to see rates artificially low. 12, going down. 13, still low. 14, etc. Right?
the ease of
So
access to capital for that
the
whole
last
time.
time we saw rates, at the yield curve look something like this, and not even inverted necessarily, right? Was the top in 2000 and the top in 2007. And so we have not seen rates at these levels in a long time. And I continue to be very skeptical that this is not going to have a negative impact on the markets within the next year or two.
I think it's
So that's
easy
how
to,
I'm seeing it. Does that make sense to
yeah.
you?
I think it's easy to see, Richard, that when people are looking at what to do with their money, and they start to get an alternative that is an alternative to the old standard mom and pop stocks, not Nvidia popping just for the short term. That you start looking at the words that you were talking about last week. You've at least got to have some sort of minimizing of your maximum regret should something come along. Yes, the market could pipe along for a little while, could even pipe along maybe even into the fall, just doing fine if we get a good earnings season. But what happens if there is something more that's tilting this yield curve other than just central bank manipulation? What if it really is there's something in the economy that's not really showing itself and is going to rear its head? I think there's a place that people can go that you talked about before. You even showed them in the FINIAC app that they could balance out their portfolio using treasuries and still get a really nice return while you're doing that and not even have to hold on to them for so long. So I think there's a couple of things that people look at when they're looking at treasuries: how long they want to hold them, and what is their risk tolerance, which would lead to how long do you want to stick around. And I think those are the two things that you've always preached about. That is the important thing to look at before you go making investment decisions.
For me, it's simple. When I look at the fact that rates haven't been this high since 2000 and then 2007, and then I look at the inverted yield curve on top of that, 6%, pretty safe for the next 2 years, looks pretty darn attractive to me. And I definitely want some of that in my portfolio. I do want to minimize my maximum regret. I want to still have some exposure to the markets. I've been long the markets, with the bulk of my money this year, even though I've been very uncomfortable the whole time and I haven't maximized my returns in the markets because I kept powder dry. I wasn't expecting this rally, especially, big tech should be hurt by rates going up like this because, with technology, it's a growth story and you're paying for their future earnings, right? Not for what they're making today. But when you can earn 5-6%, those future earnings aren't worth as much. So this should really be a headwind on tech, which is another reason I'm skeptical of the big tech story, besides the fact that I just don't like their business models. But I think this is something that people need to understand. And I think we've done a decent job of bringing it to everyone's attention today.